Good morning, dear professor. Thank you for listening to my report. My name is Weijia. The research project of mine is the impact of exchange rate fluctuations on Malaysia's export trade, an empirical study on trade with China. And I will introduce my project from the following five parts: introduction and organization structure, project objective, analytical framework, findings that include analysis, and the conclusion and recommendations. The first part is introduction and organization structure. Let's start with the research background. From 2020 to 2024, Malaysia's trade to GDP ratio was always above 100%. This means Malaysia depends a lot on international trade. And China is Malaysia's number one trading partner. In 2023, exports to China reached over MYR 210 billion. But exchange rate changes are a big challenge. When the value of ringgit goes up or down against the Chinese RMB, it changes import price. It also creates risk for companies, especially in pricing and cash flow. So during my internship at Minfeng Marketing Company, this made me interested to study the impact of the exchange rate level and volatility on Malaysia's exports to China. Next, let's see the company profile. This company is called Minfeng Marketing. It started in 2009. It makes the export plastic packaging like bags and food boxes. Around 35% of its sales come from export, especially to China. The company follows a traditional functional organizational structure comprising five major departments: the board, financial management, the export sales department, the procurement department, and the operation department. I worked in the export department during my internship. This department is very sensitive to exchange rate changes. I found three problems during my study. First, the company sets prices in USD or RMB. When the exchange rate changes, the company cannot adjust the price fast. This makes profits very unstable. And second, Chinese buyers often pay after 30 to 60 days. If the MYR gets weaker during this time, the company loses money. The finance team must save extra money to reduce this risk. And third, the company tried to use a forward contract to manage risk in 2022. But they don't have people with enough knowledge, so they stopped to plan because it was too expensive. And all these problems may be very common for small export companies. So based on this, the research objectives are as below. First, I want to analyze the monthly volatility of the RMB to MYR exchange rate and construct a volatility index using the GARCH model. Second, I examine how both the level and volatility of the exchange rate affect Malaysia's exports to China, using models to capture both short and long run effects. Third, I include insights from Minfeng marketing to understand how real businesses are influenced by exchange rate changes. Fourth, I study how volatility may impact trade through risk like cost uncertainty and cash flow issues. Lastly, I aim to give practical recommendations to help firms manage exchange rate risk more effectively. So, based on these objectivities, I focus on four main research questions. First, do exchange rate changes significantly influence Malaysia's exports to China? The second is how do exchange rate trends and volatility differ in their effects? Third, are there short run and long run mechanisms through which exchange rate affect exports? And finally, what strategies can firms use, such as pricing adjustments or hedging tools, to manage these risks? All these questions aim to connect macroeconomic patterns with firm level decision making. The scope of research and the limitations are as follows. To reduce the influence of irregular economic conditions caused by COVID, we excluded pandemic period data. The final dataset covers 36 months from May 2021 to April 2024. And the research includes variables like export value, the RMB to ringgit exchange rate, CPI for both countries, and exchange rate volatility, which is estimated using the GARCH model. The third part of my research is analytical framework. First is the theoretical framework. The study is based on these three main theories. First, the comparative advantage theory explains that when the Malaysian ringgit becomes weaker against the Chinese yuan, Malaysians' products become cheaper in China. This makes them more competitive and helps increase exports. Second, the exchange rate pass-through theory shows that exchange rate changes don't always fully affect export prices. And third, exchange rate volatility creates uncertainty. For small companies like Mingfeng, this risk can reduce export activity because they don't have strong tools to hedge against the currency changes. They may export less or raise prices. The quantitative methodology overview is below. Later, I will follow this process to explain. The data for this study comes from Malaysia's trade data with China, exchange rate information, and macroeconomic indicators. In order to ensure the scientific and economic implications of the analysis, the following variables are constructed and processed for the raw data in this project. In order to demonstrate the complete process, I will analyze each step directly in conjunction with the results rather than reporting the methodology and then reporting the results as a whole. So let's see the analysis process and the findings. First, I constructing an exchange rate volatility with GRACH model. Volatility is not stable over time, so the GRACH model helps us to estimate the changing variance of exchange rate more accurately, especially for financial data. I use this on the log returns of the exchange rate, and the result gives a time series of conditional volatility, which I use later as a main explanatory variable in the trade model. And before building the ARDL model, we need to check if our variables are stationary. If the data is not stationary, it may give us fake or misleading regression results, which we call spurious regression. So I used the ADF test, which stands for the argument decay failure test, to check for unit roots in the time series. The non-hypothesis is that the variable has a unit root, means no stationary. And this step is very important because if we get wrong, the ARDL and the co-integration result could be unreliable. So the ADF results are as follows. The table 1 shows the results for the original data. All these three variables are not stationary because the p-values are all higher than 0.05. So then we take the first differences of the data and run the ADF test again. As we can see in table 2, the p-values now are all below 0.01, which means the series are stationary after differencing. So all variables are I1, which means they become stationary after first differences. This supports our decision to use the ARDL model because it works well. And also from the results, because our variables are not all I0 and the symbol is monthly and short, so the bonds test under ARDL is a good method to test for continuation. So next part is the ARDL model selection. We use this model because it's very useful when we have time series data that are not all stationary at the same level. And it can capture both short-term changes and long-term relationships. So from our samples and the ADF test, we saw that some variables are I1, which also matches the conditions for ARDL. So in this research, I used an ARDL 1.1.1 model, meaning that each variable includes one leg for level terms and one for the differences. In this model, learn EXP, RE, and VLO is ledged level terms which reflects long-run relationship, while delta RE and delta VOL is the differences terms which capture short-run effects. So here is the result of the model. First, the model is statistically strong. The F value is 6.4 with a p-value less than 0.01, and R squared is 0.5 when it's acceptable for small sample studies. So for the real exchange rate, the current term has a positive and significant effect on exports. This means that when the ringgit becomes weaker against the RMB, Malaysia's exports to China increase. This fits with the theory of price competitiveness. However, the ledge term of RE is not significant, so the effect is mostly immediate. And for the exchange rate volatility, the current value has a negative effect, means that higher volatility reduces exports. This supports the risk aversion theory because firms become more cautious. So in short, this model shows that both the level and volatility of exchange rate matter. Firms respond fast to current exchange rate changes, especially in short-term decisions. And after the model, I use the bond testing method to check if a long-term relationship exists between export, exchange rate level, and volatility. This test looks at the joint effect of the ledged level variables in the model. And in the test, if the F variable is higher than the upper bound, then we can say that the contiguation exists, which means a long-run relationship is present. And if the F variable is lower than the lower bound, there's no contiguation. If the result is between the two bounds, then the result is inclusive. And here we can see the results. We can see that the F variable is of 13.7, which is much higher than the upper critical value, and the p-value is almost zero. So this means that we can strongly reject the new hypothesis of no contiguation and confirm that a stable long-term relationship exists among the variables. This finding is really important. It tells us that the changes in exchange rate and its volatility do not just affect exports in the short term, but also in the long run. So based on this, I continue to use the arrow correlation model to analyze short-term dynamics and how the variables move back to equilibrium over time. So let's use the error correction model, and I will call it ECM. ECM helps to explain how variables react in the short term and how they return to the long run balance over time. The key part of ECM is the error correction term, means ECT. This tells us how fast the system adjusts when there is a shock. And ECT is an error correction term to capture long run deviation in this equation. And theta is the speed of adjustment coefficient and a statistically significant. And negative theta confirms a presence of long-run adjustment dynamics. And now we can see the ECM model regression results. First, the real exchange rate has a positive and significant effect. A weaker region helps increase exports to China, especially because of price competitiveness. Second, exchange rate volatility has a strong negative effect. When the exchange rate becomes unstable, companies, especially small ones, try to reduce exports to avoid risk. And finally, the error correction term is negative and significant, meaning that after short term shocks, the system quickly returns to long run balance. So, in short, this model shows that both the level and the volatility of exchange rate matter. Firms respond quickly, but uncertainty can weaken export performance. Based on all of this, I will give my conclusions and recommendations. First, the appreciation of the RMB has a positive impact on Malaysia's exports to China. When the ringgit goes down, Malaysians' products become cheaper in China, which increases demand. This matches the theory of comparative advantage and was also seen in my internship company when more orders came during the currency goes down. The second conclusion is that the exchange rate volatility has a negative effect on exports. When the rate is unstable, it creates uncertainty in pricing and profit, especially for the small firms like my company. The third is that the results show a long-run relationship between export, exchange rate level, and volatility. Even if there are short-term shocks, exports tend to return to the balance. The error correction model confirms this adjustment process is quick and strong. All of these conclusions are useful. And based on these findings and my internship, I propose several recommendations for small and medium exports, like the interpaired in my company. First is monitor exchange rate change carefully. This is very important and no need to highlight more. And then is build a risk control system because firms should add buffer clauses in contrast and maybe can use forward contrast with banks to lock in stable exchange rates. In my internship, one 60-day credit contract lost money due to the currency fluctuations. So this really shows how important this step is. And then think long term. Even when facing short term exchange rate shocks, the companies should avoid overreacting because a long term view can help to build a more resilient and stable export strategy. And the last is that the company can consider exchange rate in business strategy, not just finance because it should influence decisions about product pricing, contract timing, and even market diversification. All of these recommendations may work. So that's all my presentation. Thank you, Professor. Thank you for your listening, and we should have a good day.